Well, as we've been talking about, stocks are extending declines today. Bond yields are sparking concerns of weaker economic growth, due in part to trade tensions between the U.S. and China, but also some other underlying issues. Joining us now, Yahoo Finance's Emily McCormick with the latest. Morgan Stanley, Emily, out with a note talking about the yield curve inversion and what it could mean.
That's right. So the U.S. economy is in recession watch, and those initial warning signs actually started 6 months ago. So that's according to Morgan Stanley analyst Mike Wilson. So everyone is fixating on that inversion of the 3-month and 10-year Treasury yield curves that we see persisting today, since that inversion of the slice of the yield curve is a reliable recessionary harbinger. But according to Morgan Stanley, an adjusted view of the yield curve shows that this inversion actually first took place 6 months ago, starting in November. And so that's when adjusting the yield curve for the effects of quantitative easing and quantitative tightening by the Federal Reserve. So in the note, Mike Wilson said that this, quote, suggests that the shot clock started 6 months ago, putting us in the zone for a recession watch, since typically an inversion must hold for some time before it's considered a major red flag. And if you remember back to March's yield curve inversion of the 3-month and the 10-year Treasury yields, that did spark some concern among investors. But since that dissipated after just a couple of days, many analysts actually shrugged that off. But again, with this thesis here, it's saying that this has been a persistent issue. And since that is a sign of a potential downturn in the economy, that's what Mike Wilson is focusing on now.
All right, thanks a lot, Emily. Let's turn to our panel on this, because as much as any trade headlines, this is responsible for what we've been seeing in the stock market over the past couple of days. Tendai, I know we've talked about the yield curve before. Do you indeed think that we're going to get a recession because of this, or as signaled by this?
Yeah, so I'm not a fan of the adjusted yield curve. I think it's an elegant analysis, but we're not living in an adjusted yield curve world, right? We're living in the world where the Fed has conducted QE and I guess some QT, and QT has been taken off the table. So the Fed is there, the Fed is acting, and it has real world effects in terms of what's happening in the economy. So I guess the idea that we've been 6 months into an inverted yield curve, I'm not very sympathetic to that.
Help us break this down, though. We're watching the 10-year yield curve come down. I mean, in 2012, it was at 1.57%. So we're not at the lows we've seen in the past. But we're also watching the 2-year come down. What does that mean for me as an investor? And why do I keep hearing people say this is putting pressure on the Fed to drop the rate it charges banks?
Yeah, so this all has to do with the mechanics of, so when you say the yield curve is inverted, what are you really concerned about? You're really concerned about banks and lending activity. And that's why when the yield curve inverts, you see banks often sell off. So what that means is that the yield curve is inverting. Banks borrow short, lend long, right? And this is...
So they borrow at the 2-year rate.
Exactly, for example, or some other shorter term rates, right? But that spread between the short term and the long term rates is basically their net interest margin or their net interest income. That's their profit, right?
And it's getting tighter.
Yeah, exactly. You flip their profit upside down.
They stop lending.
They stop lending because less loans are profitable. They stop lending, there's less leverage in the economy slows. So that's the transmission mechanism, and that's why you have to be concerned about the inverted yield curve.
And put another way, from the perspective of investors, I should be more optimistic and have more clarity on the shorter term than the longer term, right? In theory, what an inversion signals is that the shorter term could be rocky, but longer term you think you're going to be in better economic shape.
Well, I guess it's saying in longer term you're going to be in worse economic shape because you're getting less returns longer term than in the shorter term. And that's why people say when it inverts, it's signaling a recession sometime in the future, because it's saying rates are going to be lower sometime in the future than they are now.
Okay, but it depends on which you're looking at for the inversion. The 210 has not inverted.
Right. I mean, look, both are accurate sort of causation metrics for a recession, the 3s, the 3-month and the 10-year and the 2s and the 10s. What I like to look at is what is the yield curve doing in relation to everything else. So we're seeing headlines that the 10-year Treasury yield is at its lowest level since September of 2017. At that point, the S&P 500 was at about 2,500, so that was about 8% lower than where we are now. So my worry is the bond market and the stock market now are much wider than they were in September of 2017. And so does the S&P 500 need to kind of reprice? Does it have to get closer on the same page as the bond market? And if so, could that portend to further declines in stocks? Or could you look at it the other way and say, well, lower interest rates are good for stocks. They make stocks more attractive. And a big theme of last year was worry about the 10-year Treasury yield going to 3% and what that would mean for stocks.